the stock, which is moving Samsung today. Thank you.
Yeah, we mentioned those.
Yeah, okay. All right. Paul Gordon with us on the Samsung surprise announcement this morning. Let's talk about Chinese stocks once again and bring in Lillian Co of LBN. And we have some viewer emails to get to as we speak, Lillian, because Leor writes in, he wants to ask about Chinese banks and basically your opinions of these stocks going forward. Which of them will perform the best?
Basically, I think Chinese banks are one of the few sectors that still offer some value in the market. They are trading at low teens PE, their asset quality is actually quite good. The non-performing loan ratio, I think people were a bit concerned in the early this year, but now I think it's increasingly less of a concern. So actually, China banks is a sector that I quite like at the moment.
Okay, even though over the weekend Zhou Xiaochuan came out and warned about these non-performing loans because these municipal governments are having to basically borrow money for these projects that may not produce results in the future.
Right, as you said, it's something that you probably want to monitor 12 months from now, but at the moment, I think it's too early for us to worry about that.
Well, banks have also gotten a lot of support from the government as well. And another sector that has gotten a lot of government support has been the property sector, which has been booming this year. Let's talk about one of the stocks that you're recommending. CC Land, which is a real estate company on the mainland, is also something that Lillian projects will do well, so go long on this stock. But you know, CC Land up 131% already. I mean, can you really squeeze out more gains from this?
Right. It's a regional property play with focus on Sichuan province. I like it for its great value. It's actually a mid-sized property play, but its valuation is actually at a deep discount to its peers of a similar size.
Right. But our data shows, though, that CC Land looks a bit expensive. I guess if you look in terms of earnings, it's right now its stock valuation is at 200 times next year's earnings. So where's the value? Where's the cheapness?
Actually, I think for the property names, I would look more into the discount to book or discount NAV as a tool to value stocks at this stage of the cycle, because we just came off from the trough. So PE is very unreliable. So as you said, it's like 100 times, so it doesn't make sense. But if you look at it on a price to book basis, it's now only on 1.2 times, which is actually quite a deep discount to the peers, which are in general trading at over 2 times price to book already. And it is financially strong with low gearing, less than 10%. But the sector in general, you're talking about like 30 to 100%. So it is financially strong. It has the flexibility to acquire land bank if it sees fit. So I think it's a stock that I would hold on.
And what's the target price on this specific stock?
I think it can easily trade back to $7 to $8.
$7 to $8 from its current price. Well, you mentioned how you can't look at PE earnings ratios these days.
At this stage.
At this stage, yeah. Okay. It's interesting because we just got a viewer email from Frank Petruski, who says, don't you think that corporate PE earnings ratios are a poor measurement for future performance, considering today's investor, he says, is less likely to pay those high multiples for stocks that were received in the past. So is this the new deleveraged global market, he asks?
I think it really depends on which stage of the cycle you are in. As I said, it just came off from the trough, so PE is definitely very unreliable. But I think in a stable environment, PE is quite a reliable tool for you to look at. And of course, it depends on what sectors you are looking at. I think PE is extremely unreliable for cyclical sectors that just came off from the trough.
Okay, well, let's talk about another stock that you're advising people to short, which is Shanghai Electric. This is China's largest maker of power equipment, and the stock is only up about 6% on the year far, so not much interest in this stock. But you know, when you say short, I mean, how much can it go lower, I guess?
Well, I mean, we are in a liquidity-driven rally, so you can't expect a stock to go down by 50% like you saw last year. So probably 20% is the kind of downside you can hope for in this kind of environment.
20% downside on this stock.
Well, actually, it has already come off from the recent highs. by quite a bit already. So from this level to go further down, probably another 20, again at 20-30% max, I think.
Or 30%. Okay, well, Lillian, we have another viewer email just to continue on the theme of the banks. And, well, Richie writes in to ask about HSBC stock. This may not be your specialty, but maybe you can give us, I guess, a general quote on this. But he wants to know, HSBC trading near $85 or $55 in the next 3 months?
Well, again, HSBC is more like a global bank, so its share price performance will definitely be dictated by what happens in the US. Yeah, so it's more a call on US, in my opinion.
Okay, Lillian, great talking to you today. Thank you for the investing advice. That's Lillian Co of LBN, and we have more coming up here on The Edge. And Citigroup's getting bullish on a metal that's lagged behind its peers so far this year. That's coming up next. Also, we're still waiting for your emails, so send them along at asiaedge@bloomberg.net. We'll see you after this break. Stay with us.